Are market conditions changing? Stay tuned. Welcome to this week's edition of NoteSchool TV, where we go live every Wednesday at 11:05 Central Time. And this week, it is our February monthly update. It's hard to believe that it's the end of the month again. So we're 2 years into 2024, and we will certainly talk about these market conditions in just a minute. But before we do, make sure and like this episode. Yeah, hit the like button and like that. And make sure you also share it with your friends, right? Colleagues, people that you do business with. And number two, if you have not already subscribed to our NoteSchool TV channel, make sure and do that so you can go back and watch all of the episodes for the last 2.5 years. And number three, make sure and hit that bell notification, boom, so that you will know when we go or about ready to go live every week. Also, continue to send in your comments. Eddie and I love to hear from you as far as what's going on in your marketplace, your comments, what's working for you, and your questions that you have as well. Please stay tuned in with us and feel free to ask those questions. And then also, if you would like to learn more about what we do at NoteSchool, simply go to noteschool.com/TV. Again, noteschool.com/TV. And we'll talk at the end of the show today about how you can, how you can go to one of our 2-hour master classes done by none other than Mr. Eddie Speed and our Chief Market Officer, Mr. Max Keller. So we'll talk a little more about that. So now I want to bring on our Chief Visionary Officer. He's the guy out there looking over the next mountain. Founder of NoteSchool, my friend, Mr. Eddie Speed.
Good morning, Joe.
Good morning, Eddie. Hope you are doing well today. I know it is busy at NoteSchool.
It is. And the market is changing. More note inventory than we've seen in a very long time. By the way, just a little correction. We're not 2 years into 2024, just 2 months.
Just 2 months. Yeah. Eddie, sometimes, you say you've been somewhere, right? And you go, yeah, I spent 2 years there one weekend, right?
Exactly.
I guess that's what I was saying, right?
Exactly. So market update, we are definitely seeing some movement in the market, but specifically note inventory, I think for all these reasons, as we're going to talk about in there, are really coming alive. Lenders are selling discounted loans. They're selling them to clean up their balance sheet. We're going to talk about a lot of reasons why they would clean up their balance sheet. And so, yeah, we are definitely experiencing changes in the market because of the atmosphere. Today, we're going to talk about the atmosphere. What is it and what does it look like? So let's put it up there, Joe. You've done a great job of research again. Congratulations on that.
Yeah. Well, I'll tell you, it's just whether you read the comic books or whether you read the Wall Street Journal, it's hard not to see this stuff, right?
Yeah.
Everybody's talking about it. So let's start in with the housing market and what is going on there. And I wanted to first bring up, so new construction in the U.S. plummeted to a 5-month low in January, and housing starts fell 14.8% to a 5-month low there, Eddie. Single family starts dropped 4.7%, following a 6.4% drop in December. So, it's they say it's hard to blame the winter weather because we really haven't had some really severe weather. And then, of course, the final comment was persistent inflationary pressure has dampened rate cut hopes, keeping the rate on the 30-year mortgage elevated and weighing on the outlook of builders. So, yeah.
Joe, I believe it's cycle time.
Yep.
I believe that home builders are having a really hard time marking in a profit and paying interest rates that were twice or more higher than they were paying.
Yeah.
And having a hold time on properties of 8 to 10 months.
The
It's
whole time.
exactly what we talked about with Darren Bloomquist, right? This whole time in higher rate markets is a problem.
And then the cost of the mortgage buy downs as well.
Yeah. So you think about it, like how long does it take to build a house?
Yep.
Now all of a sudden the average hold time is between 9 and 10 months to sell it. Right. That's what Darren Bloomquist, told us a few months ago. And we have other data that says that. And you're looking at a huge cost of the property in interest carry.
Yeah.
And I believe that's why people are tapping the brakes. They're trying to say, let's cut back, deliver quicker, and let's tighten up our margins. And if I'm a gambling man, based on the home builders that I've talked to, that's what their vision looks like.
Exactly. So not to leave the existing home sales out of the picture here. So this is from Fred, which is the St. Louis Fed. And of course, they source their information from NAR, National Association of Realtors. And so we had right here back in December of 2023, we had the dip, but some of the existing home sales are picking up just a bit.
Or
the inventory. Yeah.
Look at the dive that we saw from, really November and December. Biggest,
look at that.
This crazy dive. So I think that was an unrealistic dive, and I think we're going to see some rebound on existing listings, availability, inventory. Basically, that's what the word we're getting in the marketplace.
And typically, December isn't a strong month for closings for home sales and closings. So
yeah, so obviously, whatever got sold, they didn't replenish.
That's for sure. All right, so Eddie, this is from ICE, and which is the new owner of Black Knight Intercontinental Exchange, and so these are the highest areas with the highest home price growth and the lowest. So interestingly, there you go. Right,
that's a great list, Joe. I looked at that list, when you first came out with it, and I thought that's really interesting information. I live in Dallas-Fort Worth.
Mm-hmm.
And people are like, oh, we're in Texas. Nothing can go wrong in Texas. Everybody's moving to Texas. Texas can't be anything but great. Well, maybe not. Houston's up there. It's 43rd. So understand that, how about Nashville? Nashville's been on fire. Everybody's moving to Nashville.
Nashville and Denver and Memphis.
So what I thought was really interesting, Joe, is a lot of places that people have talked about being the hot market. That's where everybody's going. It's business friendly. It's this and that. And they're in the bottom 10.
Yeah. Yeah.
So some places that I would say that really surprised me, of course, is California's up a little bit.
Yeah.
And I thought everybody was moving out of California.
I did too. And, but then like Hartford and Providence and Cincinnati, right?
Yeah. Cincinnati, Ohio's not a surprise.
Yeah.
It's still a value buy.
It really
All right.
is.
Great information there.
Cool. So, Eddie, according to Redfin, as reported by Business Insider, investors bought a record 6% of the affordable housing is really the thing on this one. Not so much of the housing, but of the affordable housing.
Is there a number on that, Joe?
There wasn't.
I know it changes a lot across the country.
Right. There wasn't a number on that, but it was, I think the total sales were, I don't know.
Okay. So I think that's really interesting is the investors are really making a play right now. It's very interesting because rental properties aren't cash flowing really.
I know.
You're looking at expenses still going up. You're looking at rents going down. Yeah. The margin of profit is getting thinner and thinner. on rentals, which we'll talk about as we progress. But
Yeah,
I
absolutely.
think it's really interesting how the market's reacting to that.
For sure.
People go like, "You sure are down on rental properties?" No, I just run the math every day. I have students that show up every day, and we run the math on their existing rental, and they can make more than double the profit every time owner financing than they can to rent it.
Yeah, money in the bank, not fake, real dollars, right? Eddie, you know, we've kind of bounced around this subject, and I thought, well, you know what? Here's the thing. We've got, you know, it's the reckoning for American realtors, and $100 billion in annual real estate commissions, you know, could be cut by 30%, as you had the Missouri case, which was $1.8 billion in against the NAR and some of the bigger companies like Keller and so on, and could drive more than half of the nation's 1.6 million realtors out of the industry. And Eddie, you can see right over here as we look at 2024, and these numbers are for 2024, it's starting to slip already. Realtors are having, it's a struggle out there with inventory and so on.
Yeah, there's no doubt. And, you know, I mean, hoorah to Gary Keller, right? Wrote a check and solved a big problem. I was looking at some social media on that, and you know, what a hero in the industry. Like
Really,
literally,
he is.
like
Yeah.
seriously, like the most impressive thing I've ever seen. $75 million, I believe it was.
Yeah.
And then all of a sudden there was people like, yeah, he did it because he's gonna, like, who's ever heard of somebody writing a check to solve that big of a problem for their industry? Like, who's ever heard of such?
Yeah.
So very impressive.
You know, they're a class act. We've got a lot of our folks are Keller Williams folks, and they are a class act. I mean, they really are.
But it's a changing market, and we now train a lot of realtors because they're needing to reinvent themselves. We're not taking them away from their real estate brokerage. We're becoming their wealth strategy, along with their real estate brokerage being their income strategy.
Right.
Their eating money is brokering real estate. Their wealth money is gained in note investing. So we'll continue to watch our realtor friends. We want the best for them.
Absolutely.
We got plenty of them that are our pals and close to us.
Sure.
But they're concerned a little bit.
Sure. Absolutely. Just keeping the eye out. So let's talk a little bit about banks, Eddie.
That's all going good there, Joe.
You know, when CNBC says the rates, you know, normally they're looking at not the I was going to say the ARV, but the APR, right? And now they're, you know, back over 7%, right?
Yeah.
Average rate.
I think that, you know, I've got friends in the hedge fund world, and nobody's expecting that we're going to have this big topple in mortgage rates. And nobody's really expecting that to happen. You know, a slide towards the end of the year in rates.
Yeah.
You know, but nothing like, you know, like I've read a lot of optimism, let people think this or that. When I ask my guys that are, as I like to say, they make $1 billion bets. When I ask them about it, they're like, nah, the data doesn't tell us that.
Yeah.
So mortgage applications are down. That's Captain Obvious. When you see rates go up, applications go down. So, yeah.
And, you know, Eddie, really not so much of a surprise. You know, we talked about last week, Chairman Powell's interview on 60 Minutes, and he basically said, you know, we're really looking at midsummer that maybe some of the rates will ease. We're not saying they're 100% going to, but they said, you know, we're going to get through the first part of the year and then we'll see what happens.
Yeah, I think last year when, you know, they got him and he said he was going to drop rates 6% and all that kind of stuff, I don't know. I think just the market it just changed its mind is what seemingly happened. He's not a loose-lipped guy, so he didn't say that like unaware that he was going to go back and retract, but it does seem like that's a little bit where they are.
Smart guy.
Yeah.
So Eddie, here's the rates. These are the APR rates. So we see here, you know, you're at 7.06 on the real rate, and then you're looking at here, And then I always love this on that 10-6 on that arm.
Yeah, that arm's working out really good. Guys, here's the thing. APR is including the points that it takes to close a loan and then calculating the effective rate. Many times when you read mortgage rates, they're quoting the rate that is on the note, not the effective rate. So APR is a real number, a better number. Mm-hmm. And so that's why we always go with that.
Yeah, for sure. And it is what it is. And, we're good either way, right, Eddie?
Listen, what if rates drop to 4% this year? It's not going to change any of the discounted notes that are going to come on the market. That's my contention.
Absolutely.
It might help the multifamily guys out a little bit. And we'll talk about that as we progress. It'll help it'll help the rental property business a little bit. The inventory of notes that are coming down the pike, that train has already left the station.
Definitely. And we're
in a good way. In a good way.
That's right. All right. So new rules for banks would be the end of real estate as we know it. And that's from the MBA, Mortgage Bankers Association, Eddie. This whole Basel III thing that, is kind of a worldwide thing on regulations to maintain, more stability against loan losses. It's a big thing, and it kind of raised its ugly head late last year and this year again. And whether it's an ugly head, I guess it's whatever it is. But when you look at this, the regulatory framework would mandate that banks with 100 million or more in total assets ramp up their requirements by an average of 20%. And that'll put, further stress on both commercial and residential, because it'll have, if they've got to take money out of their lending pool and put it over in reserves that you can't do anything with, that just makes it a tighter market.
Well, I think basically there's a general belief that there's going to be a fairly substantial slide in banks, that there's going to be a pretty big problem with failed banks or merger of banks that fail and taken over by another bank. I know that's not what Chairman Powell said on 60 Minutes. I heard what he said, but they also regulate the banks. And I would say that he was maybe covering a little bit, because there is, you can do Google research on this, and it's pretty widely believed that there's a problem in the banks. And the reason is pretty simple. They got real aggressive in lending money on commercial real estate, including multifamily. And that is going to be a substantial problem, right?
Yeah.
They got walled out of the car lending business because of credit unions. Mm-hmm. They got walled. They quit making profit originating mortgage loans. More banks got out of mortgage lending in the last 2 years than we've ever seen since 2008.
Yeah.
Like residential lending.
Yep.
And they were real aggressive. They could charge junk fees for commercial real estate loans, and that they got caught in the trap.
They did. And then you've got, of course, now they're pushing credit cards. We get 4 or 5 a day in the mail for pre-approved credit cards.
Well, and if you've looked at delinquency on car loans, and you've looked at delinquency on credit cards, and you look at it's, for those reasons, these are the reasons that people are saying the banking situation is what it is. We're not hoping for a massive bank.
Everybody needs a bank.
Don't get me wrong. We're not. The discounted notes that we're seeing are coming down the pike really because banks are cleaning up their balance sheets. Right. And there has been a pin-up inventory of loans that were a result of the virus, either modified loans that have become reperforming, or they're defaulted loans that got pin up and never got traded after the virus. Defaulted loans. And so that is the inventory that we're seeing, but we are watching the banking situation. Generally speaking, I will make a statement to you. When banking business gets really tough, the discount note business gets really good.
It's really good.
That's the one pattern I would say I've seen over the last, call it 44 years.
Yeah. 44 years. Wow. Yeah. So credit availability, the mortgage credit availability index is sitting down here at about 90. Well, let's see. I need to change that color. About 92.1. And it has continued to drop. And again, that just goes along with the tightening in banks, right?
Basically, if you look at that sheet, Joe, it's the lowest it's been since November of 2012.
Yeah. Yep, that's it.
It's almost down to where it was in November of 2012 and in 2011.
Right.
And
here.
if you want to know why investors are buying lower price band properties, it is because the consumer is unable to buy it with a conventional mortgage.
That's it.
Right. And so that is exactly the credit tightening. We've seen a result. We're seeing this both in residential and we're seeing it in commercial. We've seen a result of rates, but we are continuing to see a result of a credit crunch. There's a cost of credit, which is high interest rates.
Right.
There's availability of credit, which is who's lending money. And this is where you're hearing people say, my bank has shut me down. Like and now all of a sudden you look and even on the regular loan origination side, right? And this is just residential mortgages. Mortgage Bankers generates this chart. And that's really where it is.
That's it. And Eddie, somebody asked me the other day, we had reported a couple of times over the past few months about, lenders are losing about $1,000 on each loan they make. And they say, how can that even be possible with a 7% rate? But it's kind of the way the market is, right?
Yeah. They're trying to originate loans and hold the rate down, and they're not selling the loans for near as the profit that they were selling, even when rates were lower. So,
all right, well, let's talk about commercial and multifamily and talk about all that. So we'll ask the question we've talked about for the last few months, and that's all the trees growing to the sky. So let's look. Commercial real estate trouble could trigger a systemic credit crash, fund managers say. So fund managers are talking about it, and in the commercial,
they must be watching NoteSchool TV, because I've been talking about a credit crash for like a year.
Yeah,
like I'm telling you, when there's nobody to lend money, it's way bigger problem than somebody lending you money at too much of a cost of money.
That's it.
Shortage of money will be a bigger whack in the market than any other single thing. Go back, Joe.
Yep.
Let's do this. So I want to separate this because this is important. They are referring to commercial real estate here and separating multifamily.
Yes.
Okay. So it's not the same. They're separating it. Right. But because the next one shows you kind of the production, but it is all over the place.
Yes.
That mortgage lenders for commercial real estate loans are drying up.
Well, and that's it. There you have your crash, and then of course with everything else in the Basel III and all of that, this is where your lending standards make it more difficult.
Yeah,
and that's what it looks like. And this is, like you said, commercial real estate seen as the most likely catalyst, and we see it. Got further proof here. So Eddie, this is from Mortgage Point, and January marks the 6 months of year-over-year rent decline. Now the black here, or the gray, or whatever we want to call that is, and this is 0 to 2 bedrooms. But what this is here is studios. So studios have taken,
oh my God, they're crashing, aren't they?
A big hit. Yeah, that's not a bedroom really. It's just a living room with a pull-out couch, right? And then you see the median rent right here, and that's for 1 and 2 bedrooms. So yeah, it's a cost of. And here's the other part of that, Eddie. Let me get my pen going here for a second. The other part of that is, and this is again from this Mortgage Point, expenses have increased by 18.3% over the past 4 years. in expenses. And we know that, right?
Yeah, I question that number, Joe.
Do you think it's more? I think it's more than that, probably.
Well, I mean, you're saying rents. You're saying that if you add insurance and maintenance and taxes, that it's only gone up 18%.
Yeah, that's.
Like, I know that's what they're purporting. I'm just saying to you that I don't know a landlord that says, "Oh, my expenses have only gone up less than 20%." I don't know that landlord.
You know what? You're exactly right, because we're going to look at a report here from BizNow in just a second about insurance and how that's increased. So,
how about taxes? How about maintenance?
Oh, yeah. They're just getting older, right? Especially the stuff that's been around a while. But what we do know is right in here that they are declining. That's exactly what's going on in the marketplace. But you're right. I do question that. So MBA, Mortgage Bankers Association, right? Big deal, right? 20% of commercial and multifamily balances mature in 2024. So
this is where I was talking about. They've separated commercial from multifamily.
Exactly. And that's the picture I was pointing out.
Two different categories, which a lot of times they don't.
Right.
20% of all commercial real estate loans maturing in 2024. Whoa.
So yeah, and that's a big number, Eddie.
It's a $4.7 trillion.
Yes.
So multifamily isn't as bad, but it's got 12% maturing. And let me just tell you something. These maturities that were underwritten in other markets, and now the note is coming due, and they got to go do the new standard as far as what the bank equity requirements are, the new standard as far as interest rates, the new standard as far as debt service coverage ratio. And what you find right now is most people in commercial real estate that were involved in a syndication, whether it's multifamily or office or storage or whatever, that Joe, they're having what is referred to as a margin call.
Yep, absolutely.
That means you got to send more money in.
Yep. Just write a check, send it in, and we'll be okay.
That's because these maturities that we've been talking about, that train has been coming down the track, and all of a sudden this is a more severe year than last year. The next 2 years are pretty drastically going to define the market.
Absolutely.
So there you go.
There you go. Now, this is where the rubber hits the road when we talk about those expenses here. So BizNow, and it shut down the deal. High multifamily insurance rates threaten transactions, strain budgets. Insurance prices are growing for multifamily higher than any other commercial class of real estate. 26% rise in insurance costs on an average from 22 to 23, and some are being hit with 300 to 400% increases.
Well, I know some stuff that we've been involved in. Insurance premiums doubled.
Yeah, absolutely.
So it's pretty crazy. And if you look at it, multifamily has been choked out. Sales fell by 74% last year in Houston.
Yeah.
And so all of this is to really relate to, this is where we've been calling this ball with multifamily. And we have people that were, let's just say, in disbelief.
Yeah. I love the way you said that. In disbelief. Yeah.
Oh, they got their feelings hurt.
I know. They wore it right there on their sleeve, and they just kind of knock it off right there on their shoulders.
Well, I mean, they had a hell of a run. They did great. We got a lot of friends in the business. The market is just not being kind to them. And we're just trying to say the informed investor is the smartest investor. The investor that is oblivious and let's just be honest, kind of drinking the Kool-Aid. There's not many people drinking the Kool-Aid right now.
No.
They were drinking the Kool-Aid last summer. They're not drinking the Kool-Aid right now. Of course, the problem started the summer before.
It did. Yeah.
All right, let's
well, and just one other thing on that, Eddie, when you look at everything that's kind of in that pot for all of that it's been brewing up, it's new construction coming online, better, newer apartments coming on, coming online, the expenses, all of that have melted that. And, if you get too close, right?
Well, we started calling this caution flag, and we began calling it in 2022, right? And as I said, we've got a lot of friends in the industry. We got a lot of funny looks. We got a lot of people that kind of looked at us like we didn't quite know what we were talking about. And to us, it wasn't that hard to call. We just said, look, guys, you need to be aware. And there are people that totally got this. And I went to events as late as last summer, and people just act like there was, whatever. I went to events in the fall of 22 and says, you better watch multifamily. It is no way that it's going to stand up and the values are going to maintain. And people are like, oh, what is the old man talking about? and so once again, all I'm saying is we just have committed to the research and the data. We're not making the news. We're simply reporting an abundance of news about the market. So we feel like we call that ball right. And you say, Eddie, why do you care? And I care because this is driving money to our business. Absolutely. That's why I care. That's not that I'm getting joy out of go beating up our friends in the multifamily space. That's not the deal. It is driving market opportunity and capital into the note trading space.
Exactly right. Exactly. All right, let's wrap it up here. We're going to talk about non-performing. And so, Eddie, Fannie has just announced an offering. We used to see these about every 2 weeks back in the day, back in the 11s, 12s, 13s with the Freddie and Fannie releases. But this is 1,689 loans with 2.47.3 in principal UPB and unpaid balance. So
Joe, the hedge fund circle that I travel in, is expecting multiple times more loan trades this year than they've seen in the past. Multiple times, right? So this is just a reflection of, this is a big trade, $250 million trade. So it draws these are the trades that are happening all of the time. And this is a reflection of the market. It is a reflection of pin-up inventory. We've been calling this ball.
We have.
It's been a little slow to come, but boy, it seems like it is rocking right now.
Yeah. Freddie just did a trade, announced a trade back in late October that's just now closing. And Fannie just announced a trade. I didn't put it in here, but just announced a trade on RPLs, reperforming loans as well.
Yep.
So when we're looking at these other slides and we talk about 1,689 loans, it's like just really a drop in the bucket when we're talking about a couple of million.
That's it. That's it.
So this is the national delinquency rate, Eddie, and you can kind of look. It's got the delinquency rate here in blue, which is the blue line. And then the darker line is the 2000 to 2005 average, and then the record low. So we would expect this right here, right? And that's, when we had in December of 2009 as the number of delinquencies based on the other piece was there. And then we had the spike here as well. And that was kind of in the beginning of the pandemic, right? And now what we're seeing is, the delinquency rate about 3.57, which is up. And then we look at this other rate here. So as an average, and that's 2000 to 2005. But yeah, it is on that upward trajectory.
Other than FHA, I don't think anybody is expecting, Fannie, Freddie to have some major uptick in defaults. That's not the loans that we're buying. The loans that we're buying are loans that haven't paid for years.
Yes.
Right. They're way delinquent. These are the current loans. The trend in current delinquency is trending up, but their underwriting, you see how tight their underwriting is. Look at the mortgage credit availability index.
Yeah, that's it.
Right. So they've obviously tightened up. I think we're sort of addressing this because some people will read this and go like, oh yeah, current mortgages are headed for defaults. No, that's not the problem. The problem is the 2 million that already been in default for 3 years.
Yeah, that's it.
That's the issue.
Yeah. And you mentioned FHA, and I just threw this one in there. You can see that FHA is
well, let's just say, Joe, they have their own standard.
What everybody else in the industry is.
Look at the line. Look at the
right?
line, and that's just higher delinquency than the rest of them.
That's it. Yeah, so, you're at 12%, right? Compared, that's what it is. So.
Well, FHA's delinquency is trending up, and I would say that everybody sees that, and it is definitely an issue. So you see the deal with the Fannie Freddie loans, the GSE loans.
Yeah.
They're just way below that. The problem in delinquency is FHA, which is this chart clearly shows. Absolutely. All right, Joe, let's talk about some inventory.
Okay. Well, Eddie, there's 53,135,417 total active single family first mortgages. And that number, if you add this, and this, is 1,962,924 million
delinquent mortgages.
Yep.
And circle right over there to the far right. Cover the blue box.
Yep.
That is the loans that are in foreclosure are more than 1,000 days delinquent.
Yep.
That's your huckleberry. That's the loans that are going to end up in our world. Right? So we're just trying to summarize down to where it is. We're seeing reperforming loans, non-performing loans. The level of inventory is drastically different than it was before. This is what we've been discussing can happen. I'm going to tell you that it took longer to arrive than we would have thought. Right. But I can say with confidence, 2024, it has arrived.
It has arrived.
That's my message, because it's absolutely what we're experiencing.
And just for all of our viewers out there, and our chief visionary officer that you're looking at right there, he's on top of it. I know every day
we've been guessing, and we knew it was there. It wasn't like we were surprised, but we were seeing a slow trickle coming out.
Right.
That is
when was
not
that plane going to land, right? I mean,
that is not the direction that is the case right now. And I'm spending a lot of time on that side of the fence on the trade desk figuring it out. And I can tell you right now that this is what we're going to be talking about. The market conditions are simply the weather report. Now, the rest of NoteSchool TV is to talk about what you do in that kind of weather. How do you implement it? How do you monetize it? How do you make money with it? And that's what we talk about the other days, other than we have the market update. Joe, congratulations. This is an excellent report. Thank you. Very well-rounded, very clear. You're calling the ball. It seems like residential is going to be stabilized. Commercial, not so much. Loan opportunity to buy discounted notes is finally coming to the biggest fruition we've seen in 10 years. And great for summarizing all that.
For sure. So, guys, if you want to learn more about what we do at NoteSchool, simply go to noteschool.com/TV. And we would love to have you in one of our newest master classes. And it is 2 hours long. And just simply go there and say, I'd love to go to a master class, and we would love to have you. Eddie and Max Keller, our chief market officer, does that, and it really is an eye-opener for you. So we'd love to have you in one of those.
Thank you, guys.
See you guys. Talk soon.
Bye-bye.
Bye.